Hey, what's up guys? In today's video, I want to talk about buying down your interest rate, otherwise known as the 3-2-1 or 2-for-1 or 1-to-1 buy down that's being talked about so much across the industry right now. So stay with me because we're going to dive right on in. Hey, what's up guys? It's Channing, the broker owner of Bayou Mortgage, and like I said, let's talk about buying down your interest rate. Let's talk about whether or not buying down your interest rate actually makes sense in today's market. And let's talk about these 2-for-1 buy down programs or 3-2-1 buy down programs that everyone's talking about and lenders are creating events and it's just a big deal. So when we're talking about buying down your interest rate, what we're talking about doing is using money, either your own or the sellers, preferably the sellers, that's how these are being leveraged now, to buy down your interest rate so that your monthly payment is lower. Now, with a typical interest rate buy down, that's going to take effect for the entire period of the loan. So if you take $5,000 and buy down your interest rate a half a point, that's going to be across the entire 30 years of your loan. So that interest rate buy down is going to come across the entire 30-year period of your loan. It's going to be a savings across the entire 30-year period of your loan. And as a result of that, you aren't going to save as much as you are with the strategy that many lenders are promoting today, which is the 3-2-1, which is a 3-year, 2-year, 1-year, or a 2-year, 1-year, the 2-1, or the 1-1, which is just a 1-year buy down of the interest rate so that you can save a lot of money. And the theory and the thinking behind this is twofold. Number one, the market's going to change, so you may refinance later, but if you can get that lower rate for the next year or two, you're kind of playing or betting against the market to get your payment lower during that time before you refinance. The other strategy is that now, with the market kind of cooling down a little bit, and sellers, their homes are staying on the market longer. Many of them are trying to do price reductions to get those homes sold. So the logic behind it, what many are pushing, is that, hey, instead of dropping the sales price on your home and ruining the comps for the rest of the neighborhood that's trying to sell, why don't you give the buyer a $7,000, a $6,000 buy down incentive, and their payment will drop for the next year or two by a couple $100s a month. It's kind of what they say is a win-win situation. And so that's kind of the strategy behind these buy downs. And what we're going to actually dive into here in a minute and look at, I got spreadsheets, I got numbers, your boy got everything today to go over and look through this and see, is it really something that's interesting or that you should do? And I got to be honest, okay? I got to be real honest with you guys. I have been against these for quite some time, but after studying them further and learning one important feature that I'm going to talk about later in this video, I think they could be a good solution, not for everyone, but for some people. So definitely stay tuned to the end of the video so you can see what I'm talking about. But now we're going to go ahead and jump in, look at this spreadsheet that I've created, and go over what this means for you and how this can impact your home buying. So let's go. All right, so let's jump into this real quick. Let's take a look at this nifty little spreadsheet that I made over here to kind of illustrate this point. Now, this is based on a specific scenario that a local real estate agent called me today and said, hey, I heard this on TikTok, right? Because we all get the best mortgage advice on TikTok. Can you tell me if it's true and what's the deal with it? And I said, look, I know what it is. I haven't looked into it much because I've honestly kind of been against it. So shout out to the agent who knows who they are when they watch this video for getting me to research it, because what I'm going to share with you at the end of this video changed my thinking on this. So in this particular scenario, this person wants to sell. They're selling a $229,000 home. This particular scenario is a 30-year fixed rate conventional loan with 5% down. So that puts us at $217,550. And so now let's jump into what the buy down looks like, okay? This is a 30-year fixed rate. So in year one, your interest rate would be 3.75%. In year two, 4.75%. In year three, 5.75%. So what that does for you is that would make your total estimated mortgage payment, and these are rough numbers, guys, okay? This is not a commitment to lend. I'm not telling you you can buy this house for this amount. I got to run the numbers based on every person, right? This particular scenario, again, conventional, 5% down, 720 credit score, right? That's what we're working with here. The payment is $1,000 a month for principal and interest. You'll see the taxes and the PMI and all that's the same across the board. So the total monthly payment in year one, $1,572.77. Total monthly payment in year 2, $1,700.10. And then the final payment, year 3 and beyond, until you sell the house, refinance, or pass away, is until the mortgage passes away is what I meant to say. Sorry, $1,834.82. So when you're looking at these, you're getting a cheaper payment year 1 and year 2. So year 1, your monthly savings in this scenario is $262.05. In year 2, it's $134.72. Now, you would have to buy down the rate significantly. Like, I'm talking $20,000, $30,000, which is probably not even possible, in order to get this kind of savings. This is huge, okay? People don't understand how difficult it is to save on your monthly payment by either buying less or buying down the rate. It's very difficult. So the way that this strategy works is, right now you can see that if you wanted to do this, if you wanted to take advantage of this, get that 3.75, save the 262 in the first year, what you would need to do, and then the 475 and save the 134 in the second year, this is a 2-1 buy down, what you would need is about $4,700 in this particular scenario. So if you get more, if you're able to get more from the seller, or the seller is willing to offer more, or you're willing to spend more, which doesn't make a ton of sense to spend your own money to do this, then you could potentially get a lower rate in year 1, a lower rate in year 2, or any combination of the two, right? Because all that this is doing is it's saying, okay, the seller gave you $5,000. The normal monthly payment is $1,269. If you want this payment, what's the difference between $1,007.51 and $1,269.56? It's $262.05, and then you multiply that times 12, and then that gives you $3,144.60. Okay, then you go to year 2, $1,134 and $1,269. The difference is $134.72 times 12. That's $1,616.64. You add those two together, you get $4,761.21. That's the difference. If the seller gives you this money as a concession, then you could buy down your rate for the first 2 years, and that would be how that would work. Now, this could work on FHA. It can also work on VA as well. So conventional, FHA, and VA. I don't know of anybody that's offering it USDA, but someone might chirp in and say, we do, and that's awesome. For us, conventional, FHA, VA, and the particular lender that we work with that offers this only goes down to a 620 credit score. So important things to note, but I'm sure there are lenders that would offer this, for other folks. But I would imagine if you have a 580 credit score or a 600 credit score, you're going to need all the seller concessions you can get to help buy down what's going to be already an expensive rate. This may not be the strategy for you. So that, in a nutshell, is how the 2-for-1 buy down is going to work. Now let's talk about some really important things, and let's talk about why initially, I promised this at the beginning of the video, why I was against this initially. So rule number 1, right from Jump Street, this screams like we're trying to blow up and put the economy in a recession, until I got understanding on what exactly I was looking at. See, to me, if you qualify, and this was the important part, if you qualify someone based on the lower payment and then it's jumping up in year 2 and year 3, that's exactly what happened in these ARM loans that were being sold in the last housing recession in 08, in 09, in 2010, and everything blew up because the payment jumped up. The people didn't have the money. The house got foreclosed. You have that over and over again, and then boom, that with a bunch of other factors led to this massive, massive housing crisis. Watch The Big Short if you've never watched it, because it will tell you all you need to know about how that went down. But what I learned, number 1, there's 2 things I learned. Number 1 is the lender makes them qualify on the higher payment. So you can't do this if you don't qualify for what the normal payment's going to be. Now that may seem like a trivial thing, but that's going to keep a ton of people in check and make sure that we don't blow up the housing market by helping people buy houses with payments that they don't qualify for. So that's a big deal. That's a huge deal, and that was one of my biggest detractors. The second biggest detractor for me was, I know that every loan we originate right now is probably getting refinanced in the next 24 months, okay? Rates likely don't stay as high as they are. I'm not Nostradamus. I don't know the future. I just know past history. If the economy gets worse, they're definitely coming down. But even if it doesn't, no one believes they're going to stay in the 6s forever. And when that happens, which is likely to happen in the next 2 years, every loan that's originated in the upper 5s and the 6s, when they come to 4, 4.5, or lower 5s even, people are going to start refinancing these loans like crazy. It's going to be another heyday in the mortgage business like the COVID year was, and business is going to be booming. So if you do this and the seller gives you this money to do this, now it's great if they do that because it wasn't your money to begin with. But if they do this, then you could have potentially just wasted your money, because if you spend $5,000 to buy down your interest rate and you're saving $200 a month, then your break-even period is much longer than 2 years. And so whatever extra is left when you refinance, that was wasted money. So that's what I thought. That's one of the biggest, number two reason why I was so against doing the buy down. But what I learned is that this money is actually set aside into an escrow account to cover the difference. It's basically prepaid interest is what it is. It covers the difference. And then if you do refinance, if you do sell your house, that money is refundable back to you. It is a refundable amount, so you don't lose it if you refinance. You don't lose it if you go purchase or sell your current house. And for me, that was a game changer, because those two reasons were keeping me from even talking about this. I didn't even want to recommend it to my clients because it just kind of feels salesy a little bit, if we're being honest. But now that I understand some of the details about it, and that's on me, hey, I should have did the research, right? Now that I understand some of the details about it, I wouldn't feel like a total sleazebag offering this to a client. And there are some situations where if you could still get your closing costs paid for if you needed it and take advantage of this, like, the seller's going to give you $12, $13, $14, $15,000 in concessions, then I think it could be a good fit. And sellers, realtors, if you're watching this, yeah, if you have a seller that can give that much instead of taking a $10,000 price cut, then I think it's also a worthwhile strategy to look at to help keep the market strong and all these different things that we talk about. So that is buy down strategies in a nutshell. That is the current thing that's being pushed out across all social media right now. So if you have any questions about this, hey, drop a comment. I will answer. You can book a call. It's in the description of this video. DM me if you're seeing this on Facebook or TikTok. Let's talk about it. I would love to hear what you think about these buy downs. My opinion has changed. I'm not going to go out and push these on everyone, but I can at least see now where there's a situation where people could actually use this to their benefit. So hey, like always, I'm Channing. Please like this video so other people like you can see it. Subscribe to the channel and show us some love. Drop me a comment. Ask me a question. I'm ready to answer anything you have. Thanks so much. Talk to you soon.